today we're going to look at the valuation of Tesla. So it's not so much that we're going to look at Tesla, but what I want to demonstrate to you is the idea of value investing. This is very important for understanding how Warren Buffett does his investing and why he's such a genius when it comes to value investing. The concept is very straightforward and simple. What you do is you get a valuation for a company based on the earnings, based on certain ideas that you have, and then with that idea of the value, you then determine whether you should invest or not. So, for example, let's say I do a valuation of Tesla and I see that in my value it has a value of $300 billion, right? Then, if I look at Tesla and it has a market cap right now of $580 billion, well, it's overpriced in my view. So, what I can do is figure out the valuation of Tesla, looking at its revenues, looking at its track records, looking at its growth, looking at its risk. And then when I get that valuation, I can divide it by the number of shares outstanding to get a value of share. And that would be the, let's say, valuation price. So let's make it simple. Let's say there's a company and I value it at $100 billion and there's 1 billion shares outstanding. That means I would value that company at $100 per share. So if the shares are trading at $200, I wouldn't buy. It's twice what I think it's valued. But if they're trading at $50 or $75, then I would buy because they're below the value that I've given them. And the great thing with this is over time, the value of the company tends to go with the true valuation. Now, there's a couple of things that is supposed in that concept. First of all, you the way you calculate it might be the true value or it might not be the true value. But as you get good with valuations, you should approximate much closer to the true value. So, and over time, it really doesn't say how much time. It could be a little time or it could be a long time. So that's really the area that you need to look at. Um, so the other thing we're going to do is start with the numbers and then we'll see what we think about Tesla as an example. But the main point of this is to figure out how to do the valuation. So let's start. We'll look at a snapshot of Tesla. Now, this was taken in June, so last month. If we look at it today, things have changed slightly. Let's go today to the Tesla figure. So you can see 678, and when I was doing this numbers, 605. So it's actually increased quite a bit. But there's a lot of things that you have to take into account before you make judgments. So let's look at the numbers. So the first thing we're going to do, now I've downloaded this all from the internet. All of this information is available. You can go to Yahoo Finance, which is where I got this information. And basically, you just have to format it into this form, pull it from there, get it to here. The important thing is to look at a number of things. So here's all the data, how much revenues they have. Now this is in millions of dollars. Sorry, this is in thousands of dollars. So this means that 31, what looks like 31 million is actually 31 billion. So let's look here. We're looking at net income. Okay, so that's good. Earnings per share, 74 cents. That's not great. I'll explain that to you why. And then if we go to here, total expenses, and we go to net income, normalized income, what we want to do, okay, let's start with earnings before interest and taxes. That's a good place to start. And what we can see here, and this is very important to look at, you can see this 2017 over here. So this was a very large negative number, so they had a lot of losses. And then that's not as important as it doesn't matter. I mean, if the losses were here, that would be really problematic. But the losses being so far in the past, especially with the growth, is not as much a problem. And in fact, it can actually mean that there's more value in that because it's actually growing. So this is a really positive sign. Going from 1.7 billion loss to $341 million loss, that's a great improvement. And then basically very break even, that means there's been a lot of growth, significant growth in 2018, another significant growth, although not as significant in 2019. And then when we look at 2020, very much significant growth. And then the plan for 2021 is modest growth. Now, to me, this shows very strong exponential growth, but it's not what I would consider consistent exponential growth. As you can see, it's kind of great growth, okay, moderate growth, great growth, moderate growth. So that's what I would say is inconsistent exponential growth, which is not as good as consistent exponential growth, of course. So that's going to play a factor when we value the company. So now what we're going to do is we're going to assume somewhere between, I don't know why I keep getting these messages, but we're going to assume somewhere between those two values for the value to base our numbers on. But before we start, what I'd like to look at is at the time when I did it, it had a market cap of $582 billion, which we get from there, and it had a share price of 605.13. So what we can do is very quickly calculate the number of shares outstanding by taking the market cap and dividing it by the share price. So we can see there's 963 million shares outstanding, almost a billion shares for Tesla. Now, something that's very important to look at, let's go quickly here. And we saw from the other chart there was basically about EPS of about $1. And we can see that here, EPS $1 right there. Now, it has a price of 605, which means it has a PE ratio of 606, which is an amazing number. It's very high. Normally, you would see PE ratios in the range anywhere from 10 to 40. So having one 605 is very high. Now, what can affect the PE ratio and make it much greater than 20, 30, 40 is when there's a lot of growth. So if you take a company like Coca-Cola as an example, you're not going to see such an amazing growth in Coca-Cola. It's a great company, but it's kind of this giant already and it's stable. And therefore, you're going to have a much more reasonable PE ratio because it doesn't have that growth. So the only way that you can justify a PE ratio being greater than 40 is if you have significant growth. And in the case of Tesla, you can argue that there is significant growth and likely that growth will continue. So the PE ratio being above 40 is only justified when you're projecting into the future growth. If the growth has all happened and now it's no longer happening, your PE ratio should come down to 40. There's no justification for a 600 PE ratio if there's not an expectation of significant growth. And the reason for that is quite simple. Let's take a very exaggerated company, and a company, let's say, that's growing, doubling every year. So let's say they have 4 million profit this year, then next year they will have 8 million profit, then 16 million profit, and then after that $32 million profit. So you can see it grows quite significantly in a very short period of time. Now, let's say you used a 10 times ratio. So you did a PE ratio, or you basically valued the company at 10 times its profit. In the case, after a few years, you would be valuing it 10 times 32 million, which is 320 million, which is a lot greater than when you started at 4 million. So you can see in just a few years, the valuation changed from 40 million to 320 million. And that's why growth is so important. And I'll show you in the formula how we project that. So we're going to have an income base of $2 billion basically. And that's basically 50-50 between the two values if we look at over here. So now remember, there's a couple things to keep in mind with any valuation. It's not a science. It's based on formulas, which seem scientific, but there's a lot of judgment into those formulas. So even what I choose as a base, so in this case, when I look at this, what I've done is I've chosen to add, I'll just see if I can scroll up here so you can see it. But basically, this is K24 plus L24. So it's like I was saying, it's basically halfway between those two amounts. And that's judgment. So what I'm doing is I said 2020 is known and 2021 is estimated, but it's very close to 2020, so I'm going to use an average. If 2021 was put at $4 billion and 2020 was $2 billion, then I might be a bit more apprehensive of using 50-50. But in this case, they're extremely close. So whether I use that amount or that amount is not going to really change the values that much. And that's why I used an average. So that's the first area of judgment. Now, every valuation will have a lot of judgment involved. How much will it grow? How long will that growth sustain? What period of time? What is the risk factor? What's the discount factor? That's all going to play a major role in the valuation. So whatever valuation anyone comes up with, it might be valid or it might be not valid. But what you have to do is say, okay, this is valid for myself, and for myself, I'm going to use that as a way. And if you do this for all companies and use a similar concept, then you should have a similar result of whether it's valid or not valid. And therefore, you might want to choose those companies where the prices are lower than what you have valued for. So, having said that, the next main area that's going to be very tricky is the IRR. Now, normally an IRR can be used as basically a P ratio, because if you take, let's say you have a P ratio of 10, so you're going to say, I'm going to value this company at 10 times the earnings. So in this case, the valuation of Tesla would be $20 billion if I chose a valuation of 10. But that does not incorporate the growth rate. So I would be very much underserving or underestimating the value of Tesla. So let's look at different IRRs that we can choose from. So I always look at 7.5, 5%, 2.5%, and 1.5%. And if you take the 1 over those 7.5, it's basically kind of like a PE ratio. So in the case where you have a 1.5 rate, what you're saying is like a 1% rate would be multiplying the value by 100 times. So that would be the extreme low in my estimate. And if we use, so in the case of Tesla, I don't think 7.5% or 5% is warranted. These are too high numbers when you take into account the growth. So what I would be looking at is more in the lines of 2.5%, which is basically multiplying your amount by 40. And I would look at 1.5%, which is not multiplying by 100, but getting pretty close to that. It's more like about 60, 60 odd number. So in this case, you can see that multiplying that amount by 40 is going to give you 84 billion, and that's the valuation that you would come with using 2.5%. But in this case, you could be justified even going to 1.5. So let's say we're going to use 1.5%. Now remember, these are all um, judgment calls. So it's a formula based on two really big judgment calls. So I'm going to use the first judgment, 2.1 billion as the income level, and the next judgment I'm going to use is 1.5% as the IRR. And the reason I have such a low IRR is because it's justified by the growth rate. And remember, the growth was not stable growth. It kind of 1 year was high, 1 year low, 1 year high, 1 year low. So because of that, I'm not going to use a 1%, I'm going to use 1.5. So that means I would get a valuation of $140 billion. Now let's quickly go to the market cap, and we can see it's $582 billion. So the market cap is way different. Now let's look with this valuation what I think the value of the share should be at. So I would take this valuation and I would divide by the number of shares outstanding, and I would get a share price of $145. Now, when you're determining whether to invest in a company or not, if you feel that its value is $145, then don't buy at 145. Wait till there's a discount. So you might want to buy at 125 or you might want to buy at 120, but you don't buy exactly at market. So therefore you put in a strike price, and you might want to say, okay, I'm going to strike it at 20% discounts or 80% of the price. And that's basically what I've done here. So I multiplied the intrinsic price or the valuation of what I did, and I multiplied that by 80%, basically taking a 20% discount, and that's the price where I would buy Tesla at. So 116. Now, obviously, it's way off from the valuation that's today, but it could be, only time will tell whether Tesla really has that value or the value is closer to mine. I would argue that probably the value is closer to mine, and but it might take a year or 2 years for that number to change. So what am I risking here? If I'm wrong, and let's say Tesla goes up in value, well, I haven't invested in anything, so I don't lose anything, right? It's only when I'm wrong in the sense that I've overvalued something and I've invested it and then the value drops. So that's where you lose potentially in value investing. And what you have to do is you have to do multiple companies, so you start to see which companies are close to your strike price, and then you follow those. And if they're, let's say, 5% off your strike price, you might want to strike early. So that's really how you win in value investing. As Warren Buffett says, you in baseball, if there's a pitch and it goes in your strike zone, you have to swing. In investing, you don't have a strike, so you don't have to swing. You can decide to wait until the ball is perfectly hit into your strike zone, and that's when you should swing. So in the case of Tesla, I'm not going to swing at the current amount. If it does drop, I might swing later, or what could happen is my valuation can also change. Next year, if they get $4 billion in profit, well, that can change my whole equation. So that's the great thing with value investing. And really, it takes you about an hour to 2 hours to really assess what the valuation is. So, what I would suggest you do is practice on your own with a couple different valuations. Look at the base, look at the IRR, and always look, compare your valuation to the value, the market cap. And that will tell you whether you're way off, um, it's way off. A lot of times the market is the one that's way off. And let's quickly look, or if we go back to here, okay, we can't see it here. Let's go back to the actual data. So what I've done here is I've looked at 5 years. And what's very interesting is, let's go back to my calculation for a moment. So in my calculation, I've estimated that my strike price would be about $116. And when I look here, you can see that actually I would have been striking quite a bit about 2 years ago, even as recent, almost not quite, but as recent as a year ago. And then it's just jumped up. But you can see about just over a year ago, it had a value of about 150 or so. And if you look at my valuation, it's about 150. So this also goes to show that there is some logic in those numbers. And really, the main difference is how much growth Tesla will have and how much growth Tesla won't have. So if I'm projecting it to have 30-40% growth for the next 3-4 years, well, that's going to affect my pricing. But if it doesn't get that kind of growth, then I'm going to have to correct for my pricing. And that's going to be affected in the calculations. Now, this one I'm using a very simplistic version. I'll use a more complicated version because when you get growth rates much greater than the amount of inflation and for an extended period of time, that can really affect the formula and how you calculate the valuation. But at the end of the day, it's all about taking the future revenues, future profits, and taking the net present value of those future profits to today's value. But you have to choose the right discount rate, and we'll get into that in another chapter and another lesson. So have a great day. I hope that this was information that's understandable and usable, and great luck with investing. Please try to follow the Warren Buffett approach, and I'll have some links into some other trainings that can help you in the comments below. So have a great day, and looking forward to our next valuation, perhaps early next week.